Nalu FM Finance Podcast. Insight into the financial markets.
The Japanese stock market for many years hasn't looked at the stockholders a lot, and now they are looking to the shareholders. The things completely changed.
This podcast is powered by Vesta, the engine behind active management. Vesta is a Switzerland-based fintech startup that provides software for issuers of actively managed certificates to automate their value chain fully. Visit Vesta, VESTR.com to schedule a meeting with an expert and to learn more about Vesta.
Welcome to the Nalu Finance Podcast. Today's guest is Gabriel Colominas, fund manager of Japan Deep Value Fund. He's a specialist in uncovering opportunities in one of the world's most misunderstood developed markets. Gabriel has spent over a decade investing in Japan, building a deep edge through on-the-ground engagement and disciplined value investing. In this episode, we explore why Japan remains structurally inefficient, how shareholder attitudes have changed, and where real mispricing still exists in small and mid-cap stocks. We will also discuss the impact of governance reform, the rise of activism, and what meaningful dialogue with Japanese companies actually looks like. Gabriel walks us through the philosophy and risk profile of the Japan Deep Value Fund and how it differs from its more concentrated engagement-driven samurai fund. Finally, we zoom out to get some personal insights from Gabriel. Let's get started. Welcome to the podcast, Gabriel.
Thank you, Stefan, and thank you for having me today.
Let's start in, what first pulled you into Japan and what is the reason that you stayed in it for more than a decade?
It's a good question. Japan, there always has been a big market. In some moments, it was the biggest market in terms of market capitalization. Since the 90s, this has changed and has been US and China on the first and second position and third. We realized that there was lots of companies in Japan, especially small cap, micro cap companies, trading at super low valuations. We're seeing companies trading at 2 times free cash flow, 3 times free cash flow, 5 times, 4 times free cash flow. So really compelling valuations in a moment where in US and in Europe, valuations were on the rise, and where 15 times free cash flow was normal in, 2012 or 2010, now was 20 times free cash flow, 25 times free cash flow. Quality companies start to trade close to 30. And you know that after 2015, 2016, valuations only get up. So valuations were going up significantly in Europe. And in Japan, there was this big opportunity.
And what sort of has changed when you look back from 2016 to versus today, sort of?
Yeah, a lot has changed, especially in terms of culture, awareness of corporate governance and strategy and perspective. During many years, Japan had the biggest bubble that the humanity has ever seen in the 90s or in the 80s. Since then, it has been the biggest or at least the longest crisis a country have seen, because the stock market went down from the 40,000 points to I don't know how many, to 10,000 points or less in 2012. So this big trauma gets put into the mentality of all the managers, all the corporate managers, all the owners of companies, and they start to create the largest cash reserves in history in Japan and probably in part of the world. And they were not like investing or allocating or doing M&A or doing nothing with the cash, just accumulating cash for the sake of accumulating cash, because it was a margin of safety. So during many years, the Japanese mentality in corporate, which is very conservative, was only doing capex, but saving a lot of money and accumulating money, low dividends, and everything, right? And when we start, that was the mentality. And it has been like that until 2023, we say, 2022, 2023. Yeah, 2023. Because there has been a super big reform pushed by the Tokyo Stock Exchange chairman, Hiromi Yamaji. And he wants to change completely the Japanese stock market, which for many years hasn't looked at the stockholders a lot. It only take care of the stakeholders and the evolution of the company in terms of surviving, right? And now they are looking to the shareholders and meeting shareholders, because I can explain a lot of things about meeting companies in the past and meeting companies now, and the things completely change.
I mean, when you meet the companies in Japan, sort of, how does Japan compare to sort of US or UK or Europe?
It's a very good question because culturally there are lots of difference. I think that in the US and the UK, I feel it's more transactional and linked to the capital that the market is providing to them. So they look at the market as a source of capital. And when they meet investors, I think what you feel is that they are looking at the meeting as a transaction. I'm giving you information in order for you to invest in my company, and I will have better access to capital. In Japan, as a shareholder, you're not part of a family of the traditional shareholders of the Kairetsu or whatever. You're an outsider. You're not an insider. So yeah, that's very interesting, right? So they don't see you as a part of your company, especially if you are from outside Japan, right? They didn't see you as a shareholder if you don't gain the right to be a shareholder. If you are not contributive in terms of long-term investing, doing proposals to the company that makes sense, caring, like you have to demonstrate that you care about the company. They don't need capital. They need to get rid of some capital in part, right? Or do something really interesting with this capital. Share buyback dividends, buy a competitor, whatever you want, but please use this capital, right? But the question is, like, they have a cultural good reason to hold all this capital, which is the big drama that we explained.
And is there a noticeable difference also how the relationship is depending if the company is sort of founder-led or family influenced?
Yes, in general, founder-led companies are younger companies and are more open companies in terms of conversation to the shareholders.
Is there sort of a common misunderstanding among investors about Japan that is worthwhile highlighting, or they might even result in mispricing or missed opportunities?
Well, something that is not better understood by investors is that they think that Japan is not growing, right? As population in Japan is shrinking, the total GDP is growing slowly, right? Especially after that big crisis. But the GDP per capita is growing significantly. So if you take the GDP per capita in Japan and you compare it to the US, it's not that different, right? Another thing that maybe they didn't understand is that the Japanese stock market, it's not the Nikkei. And the valuations are super different. The companies are super different.
And I mean, you mentioned now a few times that sort of this the push of the Tokyo Stock Exchange since 2023 as a catalyst on how the companies behave. So I presume you're now seeing more activism a little bit in Japan. Is that friendly engagement, constructive, or does it even maybe sometimes get confrontational? And where do you try to sit with your approach?
Yeah, very good question. The number of operations in activism had grown a lot in the last years. A combination of factors are there. Of course, the push by the Tokyo Stock Exchange is an element that the number of companies with net cash available, it's also something that is driving a part of this activism. And you see a lot of friendly activism and engagement. So really engaging with the company and contributing to the company, and being a long-term investor is the only way of engaging, only way of activism.
And what kind of corporate actions do you manage to get them to do, in a sense? And is how much upside is in there? Is it dividend? Is it buybacks? Or I think you mentioned buying a competitor or something.
Yeah. When we approach engagement in Japan, we always say that we have to go from the simplest and easiest corporate actions first to the more complex and difficult to execute later, right? So we are now in an initial phase where we are proposing simple things and simple corporate actions. The first that we usually propose are about liquidity, and it's simple because there's only like two things to do. First of all, it's doing a split, because in Japan there's something very interesting, which is that each trading block, each trading action, it's at least 100 shares. So we think it's a very proper measure to do a split and to get your share from 100 euros or from 200, 500, 600, whatever, 1,000 euros to 100 to 50 to 40 to 6 euros, even, right? And the second one, we propose to the shareholders to sell some shares to retail investors only. And you sell it at a discount only to retail investors. So these measures are the ones that we propose first. And secondly, once our relationship with the company creates some trust and understanding of both parts, we start proposing dividends, increasing dividends, and especially increasing buybacks. Because as they have a lot of cash and valuations are low, buybacks are the perfect measure for them. And for that, we improve in terms, we continually improving the proposals and making new proposals related to corporate governance, related to investor relations.
So you actually slightly consultancy-led approach. I mean,
yes.
So that literally leads me to my next question. So what is the philosophy of the deep value fund and the portfolio and the risk profile? It's sort of in the sense, what does a stock have to be?
Okay, that has changed slightly since the beginning, because at the beginning we had a really deep value profile, right? So companies trading super low, traditional business, cash generation. Cash generation for us is the key. So we always focus on that. And once we have a company with a traditional business that we usually understand, and we invest in that company is looking for 5 to 10 year investment. We have some super quality companies, but from 40 companies that we have currently, maybe we have 10 of them that are amazing, super quality companies, growing and being a champion in their segment or in their niche. We will have maybe 20 that are companies that we said it's standard companies, right? So it's growing 2, 3, 4%, stable cash generation or improving margins, but traditional business. And we have 10 companies that are maybe more tech profile companies, more software, more platform companies. The average market cap of our Japan Deep Value portfolio is around 400 million euros. So there are really small companies.
Now, we have been mainly talking about the Japan Deep Value Fund. There's another one that also done, which is called the Samurai Fund. What is sort of the difference to what we've been talking about, and why did you decide to set that one up as well? In addition,
so after 10 years investing in Japan and 9 years with the fund, we decided that we want to launch a new fund, which is the one that we will launch in this 2026, which is the Samurai Fund. And this Samurai Fund, it's an engagement fund that will focus on very specific opportunities where in companies where the owners don't have a full control. So there's no companies with a family owning 40% of the shares, because we want to push a corporate change and corporate actions in these companies in an engagement constructive way, but unlocking and creating value there.
Potentially also management change as well, or?
In general, these companies are very well managed in terms of the business. The problem usually is the capital allocation. So what we will do once we launch this new fund is take some specific opportunities where we can create a position of force, taking 10 to 20% of the shares of these companies, and having a period of 3 to 5 years of value unlocking and value generation. and exiting the company in 7 to 10 years, right? So this new fund will be a fund which will be only for institutional and family investors. The other is a fund which it's for everyone. It's for retail investors.
Now, something we haven't talked about, but I guess that's important for both of the funds is, every investor will probably think about it, is that, yes, I'm happy to invest in Japanese stocks, but I'm taking the FX risk. How do you approach that one? Do you hedge it, or what's your view on that one?
It's a very good question. Since the beginning of the fund in 2016, we completely hedged our position in yens.
Yeah, you're not claiming that you know what's going to happen there. You don't want to spend your energy on researching other one, and often
Exactly.
it's driven by whatever the central banks are deciding to do, which actually leads me a little bit to my next sort of more personal questions, but how do you sort of manage your own information diet? There's probably way more information out there than you can ever actually digest, but how do you organize your life around this? Which conversation, which sources do you use? Or
In terms of sourcing information, it has changed a lot because I think in the past, Twitter, now X, was the best source of information. But Twitter has changed a lot in terms of algorithms and everything, and there's a lot of noise currently, I think. In Twitter, I continuously to use it, but I use it less. And now I research specific sources of information from Japan, for Europe, for companies, for markets, and I get these on the mail.
do you use?
Yeah, I think you're going to ask that if I use any AI tools or
Yeah, exactly.
all of them. For example, I have like for ChatGPT or Gemini for summary, I use it a lot. To research information, I use Notebook LM, which is the Google tool to study, because you can put all the reports about the company and ask questions, and the only source that will get it's the information you put there. Also, recently, a guy that has been working with us, a very young guy, has developed his own tool to analyze filings, and he started with the US and with Japan. It's called Alpha Analyst, and he's going to commercialize that this year. And we've been using Alpha Analyst for many months now, and it's amazing because we have access to all the filings from Japan translated into English, and we can search and use an AI chat which is based just on ChatGPT.
Excellent. Now, you read a lot, and I suspect you have read quite a few finance books, but is there a favorite one, and why is it your favorite one?
I think I have some of them that are very, very good. One I always recommend is Capital Returns from Edward Chancellor, which is from Marathon Asset Management letters. It's a compilation of Marathon Asset Management letters. And I like the books that helps you to develop specific investing frameworks, right? So thinking about the capital cycle in industries is something that all the managers and investors need to do. And this book helps a lot in framing you in terms of understanding capital allocation and capital cycles. One that I liked a lot, let me think. One that I like a lot was The Ascent of Money by Niall Ferguson, which is for me the greatest writer of financial history. He's a great researcher and journalist, but The Ascent of Money is great, and I read it many years ago, and it's amazing to understand all the history on the evolution of money. Another that I really like it's for sure in English. It's translated in English, but it's the first book written about the stock market. It's Confusión de Confusiones, Confusion of Confusions in English. And it's amazing because you see that the same things apply nowadays, because it's a book about human nature in trading.
I mean, I always give this option to the people. I've been asking you a lot of questions. Is there anything you would like to ask me?
Yeah, I something that I always think about people that run this type of good quality content. So when I find someone like you that's taking his time researching and understanding and finding interesting topics as you do, I always want to ask, what was the most surprising discovery that you made thanks to the podcast?
Yeah, I think one. I mean, I've been extremely lucky of getting a lot of really good people on the podcast, and they spend their time of doing it. And a little bit selfishly, I originally set it up a little bit because it's sort of my way of learning. I like to keep on learning. I read a lot as well, but I find having conversations with people also, and that's what I'm trying to do, is pass on knowledge from people who have done it already, and people can learn from, like you and many other people. But I think probably two really ones that stood out quite a bit always when people ask me. One was I interviewed Lord Stevenson in the UK. I think he was the chairman of HSBC as well. And he was already at that point in time significantly older than any other one. But he was still so open-minded and interested in learning and happy to share knowledge. And particularly, I asked him the question on, how do you do, on one hand, money, you're trying to find the best opportunity, but on the other hand, do you want to invest in a company that you don't agree, or a regime, or it's in a country that we don't agree? And he gave me a really good answer on that one, how you should see that, and you can learn, you should judge that way, that easily. That was really open. And the other one was with somebody who was involved in the Wirecard saga, on the accounting and the auditor side. Because obviously it's still ongoing, but everybody's looking for somebody to blame. And I loved it, basically because many people said, yeah, but the auditor should have known this. And his answer is like, guys, for the last 3 years, 200 people, Secret Service, police, and everybody else trying to find these people and the money, and they can't. How can we expect to do that? And it really phrased it really nicely for me that often people misunderstand what actually the responsibility of an auditor is and what actually their capabilities are. And have been cynical as well, because I was also slightly privy to some information and some of my jobs regarding Madoff and other things. And there were people pointing it out. Couldn't be, but you know nobody wanted to believe it. And as best in the Wirecard case, even the German regulator was trying to go after the FT journalists. So yeah, that was probably two of the really interesting one. And then I always enjoyed, I'm sort of a half um, uh, value investor always. One of the first ones I did with an ex-colleague and friend, and I'm actually invested with a value investor as well. I always find the logic and the rationale that value investors usually apply is a very solid foundation that makes a lot of sense to me and can be used in many aspects of life.
Okay. Very interesting.
So I enjoy these conversations with people like you as well. So that's a compliment. Last question. If people like what they heard, how is the best way to reach Ray?
Well, in LinkedIn, I'm very open. I answer most of the messages that I received, even if I'm not interested in something, I just say no, thank you. But I read everyone on LinkedIn.
Excellent. Thank you very much for joining me today.
Thank you for having me. It has been a really, really big pleasure. Thank you, Stefan.
Nalu FM Finance Podcast. Insight into the financial markets.
This podcast is powered by Vesta, the engine behind active management. Vesta is a Switzerland-based fintech startup that provides software for issuers of actively managed certificates to automate their value chain fully. Visit Vesta, VESTR.com to schedule a meeting with an expert and to learn more about Vesta.